Michael Purves is the CEO at Tallback and Capital Advisors. Mike, great to have you on the phone this morning. So if you were waiting for stocks to pull back, it looked like overnight was finally the time, and we roared back. So what does it tell you?
Well, the equity market here in the U.S. has been incredibly resilient. Over the last 6 months, we've swung from this, lingering concern about a 2020 recession to the, hey, all is good, and, let's buy Apple and semiconductors and so forth and push it to very high levels. And I have been very constructive on the market into this move, and looking out into the rest of the year, generally I continue to maintain a very constructive posture in equities. But having said that, let's just pretend all these Iranian headlines just never happened. I think right now we're getting to the point where we're getting sort of tactically overextended on equities. So even if the Iranian news flow resolves to the most constructive risk-on Iranian news flow one could get, you're looking at an S&P 500 that's almost 10% above its 200-day moving average. And every time it's gotten to that kind of level, usually, a reasonable sell-off ensues. It doesn't have to be any real fundamental indictment of the economy or earnings. It can just simply be a digestion of the very, very strong rally we've had over the last several months.
I mean, one could make the case stocks were moving in anticipation of something on the earnings front. So even if we do get some nice expectations, and some of the numbers that are rolling in, putting 2020 at $174 per share would be decent for the S&P 500, but it's still frothy, right? We're at almost 22 times trailing now. So Mike, if we do see a pullback, is there anything on the charts? Is there anything to suggest when might be the time to get back in? If it happens, again, this morning, we're up.
Well, look, I think like right now, if you draw a longer-term chart of a channel of where the S&P has been trading over the last couple of years, we are well above that, the upper bound of that channel. So, one rule of thumb could be simply to think they're going to revert to somewhere in the middle of that channel, which would be around 30.50 right now. What's interesting about 30.50 is that if you look at how the investment banks, they're sort of aggregate what we call dealer gamma, in terms of how they're positioned with all the option flow. If we break 30.50, that could unleash, a fair amount of investment banks or dealers forcing to get short the SPOOs, which would further sort of exacerbate any downside move. So that's a level to watch, but I think it's a sensitive level there. And again, I am broadly constructive on equities into this year. In fact, I've got one of the highest price targets on the street right now for the year end. Yet obviously, you and I and everyone else knows that it's not a straight line to the end of the year.
So, Mike, I just want to come back to a point about 30.50, because what you're describing basically are those with option strategies that require them to so-called delta hedge positions, right? If they drop to a point, again, we're 300 or 200 points above the area you're describing, but can you just kind of walk me through, for those that are listening, what exactly that means and how you kind of come up with that level?
Yeah, well, basically, it's a somewhat detailed and complicated exercise at how that level is arrived at. Basically, as people, there's all sorts of investors and traders putting on option positions, and they're doing that, and typically with large investment banks who are on the other side of that. So what you have to do is sort of look at the aggregate exposure of all those options, the Greeks on all those options, and again, it's a long, detailed, tedious process. But typically, what it means is that if the market swings to a certain level, dealers have to be sort of neutralizing the what we call the delta on their books, and that means if you were to break that level, a lot of short puts that they might have on their books might be triggered, and because of the nature of options, that move can come sort of suddenly and quickly, and then they're going to have to be aggressively shorting the market, right? Now, this doesn't mean that it's the end of the world. It just means that you can get some added volatility there. So it's just a level to watch if we do, in fact, break 3,100 and start looking like we're looking at, 30.50.
Okay, Mike, one other thing here that I think has been really interesting to track is the relationship between bonds and gold. I think a hugely important one is last year the two moved in lockstep for much of 2019. Then the last quarter of 2019 was about this kind of pseudo-reflation trade building, which wasn't great for bonds. Yields started to climb. One of the trades that you guys were talking about at Tallbanken was short TLT, long gold as a hedge to express a view of yields moving upwards, but watching for gold to be a hedge in that. So now do you take the profit on the gold move? Walk me through what you think about this trade now.
Yeah, so well, I think right now, look, gold was, it crested 1,600 overnight, as you were discussing in the earlier segment, and now it's sort of consolidating. I don't have my screen in front of me, but I think it's like 1575 on the futures.
Yeah, 1578.
Around there. So look, it's overstretched right now. Technically, the RSIs are multi-year extremes. You should get some selling into this spike, particularly with the more benign news flow coming out of Iran. But having said that, I think the broader thesis here is that look, gold moved up last year off rates going lower, but against a stronger dollar. Now it's kind of the other way around, where gold is moving up despite higher interest rates, but with the tailwind of a weaker dollar and what looks to be maybe a stronger European condition and a stronger condition in China there. So, look, ideally, if you're long gold, you'd love to see both the dollar weaker and rates lower. But right now, there's this sort of broader theme about sort of the de-dollarization that's happening around the world and the accumulation of gold, whether it's by central banks around the world or by sovereign wealth funds or other types of longer term investors, as well as speculators who are saying, wait, there's certainly some jump risk in the dollar to go lower or weaker against major currencies, and that will be constructive for gold, having been in a bear market for after that record spike to 1920 in 2011.
Michael, so what's interesting is we had a period where dollar and gold had done quite well together during 2019, about the first 9 months basically, as both were kind of this way to hide out from the rest of the world outside the U.S. slowing. Now, the fourth quarter was a different story, right? It was hints of the rest of the world improving. So if that's a dollar negative, which maybe it is and has been, it doesn't seem that that's been gold negative. Does that make sense to you if gold was getting so bid up on the idea that the recession was coming?
Yeah, well, look, I mean, I don't think, what was happening with gold was that, the first part of last year, as you were saying, is that you had this record rally, but particularly overseas, you had this incredible occurrence with 10-year Bund yields going to minus 75 basis points, where you had $15 trillion of sovereign credit that was in negative yielding territory, right? So gold, which doesn't yield anything, you could make the argument that was sort of positive yielding. So the case for gold right now, to go higher over the broader term, or at least not go a lot lower, is predicated that on the fact that, sure, Europe's getting better, that we might see some jump risk in the euro to 115, maybe even 120, weaker dollar, but the aggregate balance of negative yielding debt will still be very substantial. It may not be 15 trillion, maybe it's 10, maybe it's 8, we don't know. But that's going to come. Those higher rates you're seeing in both treasuries and bonds you're seeing right now is occurring in a way that is it's much more about European growth stabilizing than it is about U.S. Growth and inflation rapidly increasing, rather.
Right.
So if you look at the European surprise index that Citibank produces,
yeah, it's good. It's positive.
That's been surging, and the one for the United States has been plummeting. Right. In fact, that divergence between those two metrics is really revealing that there's sort of a pivot going on in terms of where the relative pain and relative growth is coming, and if it's coming out of the Eurozone, that means a less stable dollar condition, which will be gold constructive.
Yeah. Hey, Mike, before we let you go, about 20 seconds here, best way to hedge equities right now? I know we're talking about gold and bonds, but what about, puts on semis or something like that?
Yeah, I mean, the semis are something I'm watching very closely here. Semis have been on a huge tear. They led back in the downturn into Q4 2018. They've led on the way out. They've helped lead this broader tech rally and broader equity market rally. They're starting to look, I think, not just rich, but also technically vulnerable. And so I'm looking at that as a signal. And the look of in a good old-fashioned market correction, for whatever reason we may get it, maybe Iran, maybe just people wanted to take some profits. Look for those technical signals on tech-related indices on some of the key stocks like Apple to start showing signs that upward momentum is fading.
Yeah.
That's your entry point for hedges, particularly when volatility is still reasonably low.
Really good stuff, Mike. As always, appreciate you walking through multi-asset classes with us. Michael Purves, CEO at Tallback and Capital Advisors.